Back in the day, you had to be in a restaurant every minute of every day. I have real-time apps where I can actually see what we're pouring, literally what beer is pouring currently, instantaneously, what we're doing in sales in different places, who we have on, all these different stuff. This has made it so that I don't have to be in our single restaurant 18 hours a day. I mean, I'm 18 hours a day, I'm looking at it for 5 different restaurants and saying, I give calls and texts and I can communicate with the manager and I can really play marionette from a distance. Not that I'm not in the restaurants, it's just that I can now spend 3 hours in this restaurant and then 3 hours in this restaurant and then 3 hours in this restaurant and then 3 hours in this restaurant, but still have sort of my invisible touch in all of the different places, which if you really want to run a good restaurant, numbers are truly important for you staying alive.
This video offers insights and inspiration on why a cash flow budget is an important tool for managing money in your business, action steps to take now if the budget predicts a shortfall of cash in the future, tips for managing the cash flow cycle of your business. After viewing this video, use Northern Initiative's Cash Flow Planner tool to create a cash flow budget for your business. Why create a cash flow budget? Running out of cash continues to be the main reason businesses fail. A cash flow budget is an extremely helpful tool to estimate what amount of cash will be available each month to pay the bills due. If the budget projects a cash shortage in the future, the business owner can plan a course of action to improve the situation. Who benefits most from creating a cash flow budget? Well, a cash flow budget can be helpful to any business, but especially important for a business that is seasonal or carries accounts receivable and inventory. Seasonal businesses generate the majority of their revenue during a short period of time each year, but may have expenses every month of the year. A cash flow budget will help the seasonal business owner plan for the amount of cash he needs to reserve from the high sales periods to pay for expenses during months where sales are low. Businesses that carry accounts receivable have a lag between when a sale is made and when cash for that sale is collected. In the meantime, expenses need to be paid. A cash flow budget will help the business owner to focus on efficient and timely collection of accounts receivable in order to generate the cash needed to pay the bills each month. Inventory purchases require a cash payment to vendors within a short period of time, generally 30 days. If the time it takes the business to sell the inventory and receive cash is longer than 30 days, the business will need to have cash available to pay the vendor on time. Additional costs, such as late fees and interest, may be incurred by the business if payment to the vendor is late. The added expenses reduce the profits of the business. A cash flow budget will help the business owner plan for cash needed to pay vendors on time. Let's look at an example of cash flow for each of these scenarios. The seasonal business. In this example of a seasonal business, 65% of annual sales are projected to be generated in just 4 months, from May through August. At the beginning of January, the business has $5,000 in cash and hits the lowest level of cash at the end of February. Cash begins to rise and hits a high level in September and then declines as sales drop off. In December, there is $2,850 left in cash. Total cash sales for the year are projected to be $77,500. Is the ending cash enough to cover next year's fixed expenses during the months with no to low sales? If not, here are some possible actions to consider implementing now. Consider a price increase. A 3% increase in the price of the product or service would result in $2,325 additional cash for this business by year end. Develop a plan to increase sales. Is it possible to add more sales volume during the year using current staff levels? Is it possible to decrease vendor costs? Projected payments to vendors for the year total $23,250. The owner could ask her vendors for better pricing, or pay the vendors early if a discount is offered, and you have the cash. A 2% discount saves the owner $465 in annual expense and increases cash by the same amount. Review fixed costs. Are all other fixed monthly expenses managed to the best price and most efficient use? This example is a business that sells a service on credit. The terms given to clients require full payment in 30 days. A look at the top line of the income statement shows $20,000 in sales in July, August, and September. However, if some of the accounts receivable take longer than 30 days to collect, there's less cash available for the business to pay its monthly expenses on time. Sales of $20,000 in July should be collected in August, but only $15,000 is collected. The same happens the following month. The result is a declining balance in the cash at the end of each month. Let's look at the impact on cash if accounts receivable become past due. To start, we need to reference the business financial statements, both the income statement and the balance sheet. Customers of this business are given 30 days to pay their invoice. Are they actually paying within 30 days? To find out the average number of days it takes to collect the outstanding receivables, follow these steps. First, calculate the accounts receivable turnover. Divide sales by accounts receivable. The accounts receivable cycled 7.8 times in the current year. Now let's convert this rate to number of days. Divide 360 days by the turnover rate of 7.8. It takes 46 days on average to collect accounts receivable that are due in 30 days. Now let's calculate the cash impact for this business. How much more cash would the business have in the bank if the receivables were collected in 30 days? Well, first, divide 360 days by 30 days, the target collection period. The accounts receivable should turn over 12 times per year for this business. Then divide sales by the target number of turns to see the accounts receivable balance. If the business collected receivables in 30 days with sales of $250,000, the accounts receivable balance on the balance sheet would be $20,833 instead of $32,000, and there would be $11,167 more in the cash account. What can a business that holds accounts receivable do to improve the cash position each month? Review and tweak the accounts receivable policy. If there is no accounts receivable policy, create one and follow it. Options to improve include require a cash deposit from customers, offer a discount for early payment, only provide accounts receivable option to credit-worthy clients, make regular calls when invoices become past due, calculate the average number of days it takes to collect receivables and compare to prior years. Is it taking longer to collect? Shorter? What changed if there is a difference? Check out the average number of days it takes industry peers to collect accounts receivable. Strive to match or better that rate. A business that carries inventory may have to pay for that inventory before it's sold to customers. Some businesses buy seasonal inventory up to 6 months or more in advance. For example, retail clothing stores and recreational vehicle dealers. The vendors may provide manageable payment terms, lines of credit, or other options to help finance the inventory purchased by the business. If the inventory is sold to a customer on credit, an accounts receivable is booked. A sale was made, but no cash was collected. The business owner waits another period of time before cash is collected from the sale. The classic working cash cycle starts with cash used to buy inventory. As inventory is sold, it brings in either accounts receivable or cash. The faster the inventory becomes cash, the better. Managing inventory turnover is like managing accounts receivable turnover. The more it turns, the faster it becomes cash. Let's look at the impact on cash if inventory sits on the shelf too long. Once again, we need to reference the business income statement and balance sheet. First, let's calculate the inventory turnover. Divide cost of goods sold by inventory. The inventory cycled 3.7 times in the current year. Now let's convert this rate to number of days. Divide 360 by the turnover rate of 3.7. It takes 97 days on average for inventory to be sold. So, what is the cash impact for this business? Well, suppose the peer industry sells inventory in 80 days on average. How much cash is this business tying up by taking 17 days longer to sell? Divide 360 by the target number of days to sell, which is 80. The inventory should turn over 4.5 times per year for this business. Next, take cost of goods sold and divide by the target number of turns to get the target inventory balance. If the business sold inventory in 80 days with sales of $250,000 and cost of goods sold at $112,500, the inventory on the balance sheet would be $25,000 instead of $30,000, and there would be $5,000 more in the cash account. Consider these options to efficiently manage inventory turn days in your business. Buy smart. Purchasing a large volume of inventory to get a good price may not be the best idea if you can't sell it in a timely manner and recoup the cash. Consider your target customer. Don't buy inventory that doesn't fit or appeal to your target market. Compare vendors. Will a new vendor provide you better pricing, better terms? Eliminate obsolete inventory. Products that sit on the shelf too long rob the business of cash that could be used to buy newer, more popular inventory. If necessary, reduce the price to move the product, and remember to buy smart. Calculate the inventory turn days for your business. Compare that figure from year to year. Is it consistent? What action steps can be taken to improve your inventory turnover? So, what other options do I have to increase cash in my business? Efficient cash flow management starts with creating a cash flow budget, identifying areas to improve, and implementing a plan to manage the cash flow cycle more efficiently. But sometimes there's a need to utilize other sources of short-term cash to maintain operations. Line of credit. Many businesses that carry accounts receivable and inventory benefit from a line of credit. A line of credit is granted by a bank or other creditor and allows the business to borrow from the line during periods where cash would be negative. Lines of credit are meant to be short-term. The money borrowed is repaid during the months where cash balances are higher. Seasonal businesses benefit from accessing a line of credit during the low sales months to cover fixed expenses and then repay the money borrowed when sales and cash are higher. Owner or investor equity. Business owners may have to periodically invest cash themselves or take on an investor. A business that's growing and expanding will need additional cash to pay for more inventory, accounts receivable, or fixed assets. In addition to traditional bank loans, cash invested from the owner or investor helps to fund the planned growth. So, create a cash flow budget for your business and update it on a regular basis. It's an essential planning tool to ensure there's adequate cash on hand for business operations. To get started, access Northern Initiative's cash flow planning tool found in the business portal.
I just think that the most important thing when it comes to cash flow is knowing what your numbers are. Probably the number one thing you can do is have a point of sale system that gives you data. And the more data it can give you, the better. The more that you can dig into the numbers and know your numbers frontwards and backwards will determine how well that you can manage your cash flow.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and we care a bit more because it's not profit for us, it's prosperity for all.